Hello, and welcome to episode 9 of the Eye of the Needle podcast from Columbia Threadneedle Investments. I'm Mark King, Head of Content for EMEA. So it's time for another lockdown episode of our podcast. And this time round we have 2 more of our investment professionals lined up to give you the lowdown on how they are working and investing during the COVID-19 crisis, as well as the market impacts they're seeing. We'll cover European equities with client portfolio manager Francis Ellison and Japanese equities with portfolio manager Daisuke Nomoto. Please note that all the market data contained in this podcast is sourced from Bloomberg as at the 17th of June 2020. So without further ado, let's find out which types of business have done well in Europe since the pandemic began, why European banks have the odds stacked against them, and what investment style might remain in fashion for some time yet. I'll hand over then to Francis Ellison, client portfolio manager in our European equities team.
So we have to confront COVID-19 and the year of 2020 so far with a bit of humility as fund managers. Humility for a couple of reasons. Firstly, because there have been periods in the year where we lost money for clients, and that's always painful. We beat the indices, and actually indices have turned around, and we've beaten the indices enough to actually generate positive returns for clients now. But secondly, because this is a human tragedy. It's a human tragedy in medical terms, with people having lost their lives, and in social terms, because people have lost their jobs or been furloughed. And we, sitting in the financial services industry, particularly at Columbia Threadneedle, we are happy to be in the situation that we can work, that our operations continue unabated, and that we're continuing to be able to do good work for clients. But not everyone can do that. So you can see from what I've said that the economy, in a sense, is two-speed. There have been businesses within the economy, and that's reflected in the stock market as well, which have actually done reasonably well in this crisis. Companies which have capitalised on the medical opportunities, vaccines, testing, companies which have capitalised on technology, because a lot of the trends in technology were already there but have been accelerated by COVID-19 and lockdowns. So moving to online working, all that entails. What retail expenditure there has been online. That involves new technologies and new businesses to address those. And we've been concentrating and focusing on those within our portfolios to a greater extent than we were in the past. But there's sectors which have suffered, and those sectors happily are not so much reflected in our portfolio. Sectors such as the hospitality and travel area, but also insidiously the banking sector. The banking sector has traditionally in our European portfolios been an underweight position. We're not like banks because of technological challenges, also because of areas like overcapacity, but also because loose monetary policy, and that monetary policy is even looser now to address the problems of COVID-19, will affect banks' profitability, returns and margins. So we see a continuation of underperformance from that sector, not because there are not intelligent and professional and good managers of banks, but because the odds are stacked against them. They have a headwind in terms of low interest rates. They have a headwind in terms of selling products where the prices are fixed in a commoditized way by central bank policy on interest rates. They don't control their destiny. So our quality focus and the analysis that we have done in a unique way over many decades to assess the quality of business models, to work out which businesses will survive, thrive, generate high returns for customers, that's actually worked even better in this crisis than it did in our successful year 2019 when we beat indices in a rising market. And the victims of this crisis in investment terms have been the so-called value stocks. There's been a value rally recently. There was a value rally in 2016 and in the end of 2018. These things do happen, but they tend to be relatively short-lived because if you don't have that quality of business model, the predictability of where your business is going in the long term is not robust. And therefore, for a long-term investor, there are too many challenges. That doesn't mean to say we won't invest in cyclical businesses. Some cyclical businesses do have high visibility. We're mainly focused on businesses which we are confident will be larger businesses, larger companies in 10 years than they are today. And if the ride is a bit bumpy in the interim, that won't necessarily disturb us if we know that in the difficult times, a business will be doing better than its competitors and winning market share off them. So COVID-19 has been sobering, but it's been a period when we've outperformed indices and we're confident and aiming to continue to do that in the future.
Many thanks to European Equities Client Portfolio Manager Francis Ellison. Our second and final guest in this episode will be Daisuke Nomoto, Japanese Equities Portfolio Manager. Daisuke is going to explain what stimulus the Bank of Japan has undertaken to cushion the impact of COVID-19, how the Japanese equity market has been faring, and the outlook for corporate Japan. Over to you, Daisuke.
Most asset classes proved tough to navigate during the liquidity crisis as a result of the COVID-19 pandemic, with Japanese equities no exception. However, the unprecedented monetary and fiscal stimulus has effectively mitigated liquidity and solvency concerns globally. The Bank of Japan announced numerous measures to reduce the impact of COVID-19, doubling its annual capacity to purchase ETFs and REITs, and increasing the purchase of various kinds of fixed income securities. The total size of the fiscal stimulus was $2.2 trillion, which is around 40% of Japan's GDP. It was actually one of the largest fiscal supports globally relative to the size of the economy, and even exceeded the amount of Japan's stimulus measures during the global financial crisis. So far, it appears that Japan has been able to manage the COVID-19 situation relatively well, with the number of deaths per capita only 1 to 2% of that in more severely affected countries. The state of emergency in Japan was lifted 2 weeks ago, and it seems that economic activity is gradually normalizing. Although the share price recovery has been somewhat quicker than we expected, we still believe the Japanese equity market is attractively priced. Interestingly, Japan has now become the second largest market for activist investors globally, behind only the US. Approximately a half of Japanese companies in the TOPIX index is trading below tangible book value. Investors have identified the Japanese companies are extremely cash-rich, with roughly 50% of non-financial companies net cash, which is 2 to 3 times higher than that in the US and European equity markets. Furthermore, dividend per share for Japanese companies has grown more rapidly than any other market since 2012, while the share buybacks have risen approximately 70% year over year. During the unprecedented volatility in markets, we continue to adhere to our disciplined investment process by focusing on the companies we want to own in the long term. We have been upgrading the quality of our strategy by taking advantage of share price dislocation, increasing our exposure to those companies with solid balance sheets and high return on capital. Basically, we have focused our research into 3 groups. The group number 1 is those beneficiaries, increasing exposure to companies that are witnessing accelerating secular themes such as semiconductors, IT service, and e-commerce companies. The group number 2 is those companies experiencing short-term pain, holding on to companies that are likely to feel this pain but have the potential to emerge in a better market position. This includes names such as factory automation companies and business service providers. And the group number 3 is those companies we view as impaired. We stayed away from companies where their ability to survive is in question, such as airlines and some retailers. We expect the Japanese equity market to remain volatile in the short term as COVID cases may pick up from time to time in some areas. However, stepping back from the near-term headwinds, Japan's structural reform, ranging from labor reform to corporate governance reform, will be transformational for corporate Japan in the next decade. While a combination of attractively valued companies and a large stimulus package will provide further support, given our differentiated investment process focusing on attractively priced high-quality companies, we believe we are well positioned to effectively exploiting efficiencies in the Japanese equity market.
So many thanks to our 2 guests in this podcast episode, Francis Ellison, European Equities Client Portfolio Manager, and Daisuke Nomoto, Japanese Equities Portfolio Manager. We'll be back very soon with more audio from our investment professionals. Until then, if you do have any comments or suggestions for the Columbia Threadneedle Investments podcast team, pop us an email at podcast@columbiathreadneedle.com. See you next time.
Important information. Your capital is at risk. Past performance is not a guide to future performance. The analysis included in this podcast has been produced by Columbia Threadneedle Investments for its own investment management activities. Information obtained from external sources is believed to be reliable, but its accuracy or completeness cannot be guaranteed. None of Columbia Threadneedle Investments, its directors, officers or employees make any representation, warranty, guarantee or other assurance that any of these forward-looking statements will prove to be accurate. The mention of any specific shares or bonds should not be taken as a recommendation to deal. This podcast is not investment, legal, tax or accounting advice. Investors should consult with their own professional advisors for any advice. Issued by Threadneedle Asset Management Limited, registered in England and Wales, number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG. Authorised and regulated in the UK by the Financial Conduct Authority. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies.